that the dollar, of course, is not the market to trade. The market to trade, of course, is going to be something that has no dollar influences. And as a result, things like the Australian dollar against the Japanese yen come to mind, doesn't it? That type of market where we've got the Australian dollar against the Japanese yen and we start saying to ourselves, no, you know what? That's where the money's going to be. That's where the money shot is going to be, yeah? We warned the other day, Paul, didn't we, about the dollar having this dual personality. It's almost a Jekyll and Hyde. The dollar is probably one of the most difficult markets on the planet to trade for that reason, because it has the upside in a risk off, and it also has that upside in a risk on type environment, depending upon where the dollar finds itself. We warned yesterday that this was one of those real problem child type trades. It could be one of the problem childs that we were talking about. Today proved the point. Today proved exactly the point when we started to understand the concept of risk on and risk off and all the various things that come from that storyline. Because the whole storyline we painted yesterday, Kim, actually was 100% spot on. 100% spot on. Because if you look at what we were talking about yesterday, we were talking about equity duration. Equity duration, because it is because it's lining up with the concept of interest rates, is a brilliant narrative, isn't it? A brilliant narrative. Now, I'm not sure if we ever finally got to the end of answering Herman's question, so apologies, Herman, if we didn't. But I'm still not sure that I'm picking up exactly what the question was, to be honest. I kind of looked back at it and I thought, I don't know what the question was. It was just a misunderstanding. But one of the things that we're obviously looking at is the idea that the 2's 5's is interest rates. That's what our use of the 2's 5's is. It's predicting where the short-term interest rates movement is going. In other words, sensitivity to bond prices. Sensitivity is what we're measuring when we measure duration. So when we start thinking about that durational aspect, we've got these Russell against the S&P and the Russell against the NASDAQ stories here. Well, we know if the Russell against the S&P and Russell against the NASDAQ is dropping, that's a risk on market, correct? That's a risk off market, sorry, when it's dropping. That's the first thing. There's a directionality to these risk markets. Everybody understands that. I think everybody understands that. There's a directionality. If the Russell market's dropping against the NASDAQ, that suggests there's a risk off tone. Why? Because the NASDAQ will lag, because if there's a risk off tone, interest rates will be dropping. If interest rates will be dropping, the NASDAQ will be overpriced against the Russell. The NASDAQ will probably be overpriced against the S&P, in fact, as well. So we know the NASDAQ in a risk-off environment is probably going to be overpriced, and when the market turns into risk-on, it's probably going to be underpriced. So selling the NASDAQ on the way down and buying the NASDAQ on the way up, it becomes a traditional approach to trading equities. Of course, that's how it works. So the first thing we can already start recognizing is I'm always looking now for the blue line to be above the orange line. The blue line, of course, tells me that the story is building. The story is really starting to build. That's what I'm starting to look for. Because as the orange line diverges against the blue line, that's telling us that that Russell NASDAQ, Russell S&P narrative is working out on the risk-off tone. So if the blue line starts drifting higher than the orange line, which it did in this phase here, you can see it, albeit subtly, and it did up here. The blue line's a lot higher, the orange line is just touching into the highs. So we're already feeling that this is a risk-off environment that was forming here, and when it started to sell off, it was confirmed, of course, risk off. So, you might say, so what? We moved into a little risk-on environment here where they turned, and we had a little risk-on, short duration. And obviously when they turned back down again here, we started to look for those opportunities. And there was a very, very nice opportunity actually just in here for a risk-off trade right there. Risk-off trade right there. And that's an additional short play. Now you might be looking at that and saying, yeah, I get this durational quality trade. I understand that. But if we look at the 2s, 5s, it should look the same as this, shouldn't it? So if I look at the 2s, 5s, and I ask the question, what's happening on the 2s, 5s, it should obviously be the same answer. Does everybody agree that the 2s, 5s is pretty much exactly the same answer? Absolutely, right? So if this is almost exactly the same answer, this gives us quality, it gives us confirmation, it gives us an idea that these trades are setting up in the same place, doing the same things. We obviously have context to build in. We know that there's obviously going to be little edges that we can maybe get a buy on bonds or a sell on the S&P or a sell on the NASDAQ if that's what you're looking for. There's always edges that we can try and work based on the overall macro view and the underlying micro trade as well. So when we look at this move higher on the 2s, 5s, if we zoom out a little bit, you'll see the 2s, 5s is way, way, way overpriced against this line, or this line is way underpriced against that line. But we know this line isn't underpriced because of the rotational aspects of the blue above the orange. Do you understand that? The natural opinion would be that perhaps if I buy some blue line and sell some orange line, that this is what the trade would be. That's wrong. If the blue line is above the orange, this is going to be a sell. If the blue line's trading above the orange line, it's going to be a sell. Now, you might be looking at it saying, I'm not sure that that's that visible. It bloody well is visible. If I draw a line, for example, from here at midnight, just a line because that's the high price. Look, the orange line literally just touches it here. What does the blue line do? If I draw the same line off the blue line, is the blue line clearly above that pink line, yes or no, during this morning session? Clearly above. It's not just a small, difficult to see storyline evolving in the background, is it? It's actually obvious. It's crystal clear that we're in a risk on, risk off. It's going into a risk off market. It's crystal clear. Well, if that's crystal clear, I can't buy this to sell this. If that's crystal clear that that's dropping and it's already discounted against the 2s, 5s, I've now got an amazing story to sell the 2s, 5s, which is the same as doing what? It's exactly the same as buying bonds, isn't it? I've now got a storyline to buy lots and lots and lots of treasuries, which is quite exciting because obviously the absolutes were already bullish bonds. The inflation break-evens opened gap up on bonds. So we already had those incredible internals for the bond market telling us bonds were going to go straight north. Unbelievable, I hear you say. So what's the problem for dollar traders? Because we told you the dollar's the problem child of the marketplace. We've tried to get you to kind of, in most cases, to avoid the dollar and perhaps trade some of the crosses as well, unless you understand this idea. Because this is when you're going to get unstuck on the dollar, isn't it? Because obviously the dollar should follow suit, except when it doesn't. Except when you're getting a black swan risk event like we had this morning. A kind of, I'm not saying the market's obviously a black swan event, guys. It's not a crash. It's a small sell-off in all honesty. But it's still a good small sell-off. It's not one of the smaller small sells. It's a good solid sell-off. So it's not a black swan event, but I'm hoping by using the word black swan, it's allowing you to just to visualize the impact that this could have had potentially in this market. Because why would this be looked at as a black swan? Because the dollar should obviously fall if it's not. Because the dollar would naturally be adjusted lower on lower yields, right? That's the normal, inverted commas, the normal market condition. So if the dollar doesn't get adjusted lower during this sell-off phase here, if the dollar's drifting higher, you're already thinking to yourself, that's not a good sign. That cannot be a good sign in anybody's book, right? So when we look at the dollar, what did the dollar do? The dollar traded beautifully in line with the positive correlation that we all know is the market truth. the dollar was very, very low here when this started to rise, somebody started to buy an awful lot of dollars. Now, you don't know that's happening until it starts going up, but obviously it's very cheap according to what's happening against the, certainly against the 2s, 5s, the dollar looks really cheap at that stage, doesn't it? So unless you're actually already on top of this as a story, your trade this morning would have been to buy dollars, yes? That would have been your trade this morning, wouldn't it? To buy dollars into that storyline. So your long dollars actually is already in place if you're just trading this normally as you would have expected. So why does it do what it does here? Because obviously when this starts falling, you would have imagined from this upright that as we move the dollar into the prior swing highs here, you'd have immediately thought to yourself, there's going to be a lot of sellers up here. So why did it keep going on? Why did it keep going through? Because it was no longer the paradigm, was it? With that sell-off picking up ahead of steam, with the sell-off starting to pick up ahead of the steam, and it hadn't even started yet, but nobody was selling dollars. And if nobody's selling dollars, guys, in that environment, you've got to be looking at it saying, this is dangerous, guys. This is adding a lot of danger to this story. And you see the dollar went on to make some very, very significant gains. The dollar should have been selling off, shouldn't it, in a normal world? Big mistake. Big mistake. And yet, when I talk about the dollar being the problem child, you would actually have ended up being in the right trade at the beginning of that trade anyway, but you would have possibly tried to flip it here, and that's when you got unstuck. That's why we don't trade the dollar as much. Because the dollar is a problem child. The market that's not a problem child is something like the Aussie yen, of course. Because the Aussie yen is always these lines. The Aussie yen is always these lines, guys. If I look at these lines and I now overlay the Aussie yen, guess what happens? Completely the opposite to what happened in the dollar. Take a look at the Aussie yen and tell me how much better this line is. Is it not exactly the same line? Is it not exactly the same line? Damn right it is. So in other words, the movement of the Aussie yen is almost identical to the 2s, 5s. It's not divergent the way the dollar diverges because of a risk change in the marketplace. It's never got that story. Yes, there can be, of course, some market internals for Australia or Japan that maybe causes a little bit of a flux, a little bit of a fluctuation in the relationship of R squared. But that's an awful lot rarer than it is on the US dollar because of the risk flows. Nobody ever flows into the Australian dollar for a risk-off flow market, guys. It's a high beta, high commodity market. So on that basis, nobody ever buys the Aussie dollar for risk-off sentiment. They'll buy Swiss francs, they'll buy Japanese yen, and they'll buy US dollars. So this is always going to be tight to this market. It's a great line. It's a great market to trade. So you might not desire to trade the short 2s, 5s. You might not desire to buy bonds, but you could have sold some Aussie yen up here. You could have got some short 83.30 Aussie yen. And yes, guys, 83.30 dropped to 82.20 for 110 pips. 110 pips on the Aussie yen short from that high print price right there. You couldn't make this stuff up. If it was impossible for me to show it on a screen, you just wouldn't believe it was this possible, would you? You wouldn't believe that it's actually really, really easy to spot these as stories. We know the dollar's a problem. We told you the dollar was a problem yesterday. So we know there's a problem in the dollar. We know there's a problem in the dollar yesterday. We know there's an issue. So we can obviously trade this. We can trade this, can't we? Well, there's Aussie and there's yen futures, David. So you could obviously do the Aussie yen on that as a pairs trade the same way as like a NASDAQ S&P or a knob spread trade. You could trade it the same way. But yes, I mean, there's no specific future that's got any volume, so you could trade the Aussie yen forex markets, of course. So you could either trade it in futures markets as Aussie and Yen, or you can trade it in the Forex markets as the Aussie Yen pair. And it's a pair that has, in most cases, a really good spread. It's one of those markets that actually genuinely can give you a good price. And what an outcome, guys. What an outcome. Crazy outcome, isn't it? Crazy outcome. So welcome in, guys. I hope you're all good, ready to rock and roll. We've obviously going to see a bit of, I would imagine, a bit of fireworks this morning going into the cash open. We want to touch on backwardation, contango, and volatilities again today. Because last night we had a very, very big shift, which is why I put out such a strong care warning. So you're not going to be mistaking the fact that this isn't a hindsight classroom, because we actually gave the warning last night. And therefore, this is something that we're just exploring to make sure that you understand what it was we were saying last night by understanding the concept of contango and backwardation. So that's what the classroom this afternoon is going to contain. And in the meantime, welcome in, guys. I hope you're all good, ready to... There might be fireworks. There might not be any fireworks at all, but there might be fireworks. We've obviously swept the 47 handle again on the S&P down here. So we've already taken out the biggest of the big swept levels. Of course, it's a Friday, so we're going to have a lot of expiries coming out today as well, and that might just cause a little bit more rotation. But obviously, once those expiries pop, it could cause a lot more hedging if it ever starts breaking out. But if it stays inside, then obviously that's obviously a big relief. So you're obviously very, very sensitive to every 10 points, guys. Every 10 points and the 75s. This morning, every 10 points in the 75s. The 5's not as important, we already know that. But every 10 points and the 75s, guys, make sure you are on the button for these moves. Every 10 points and the 25s, the 75s, and obviously the zeros. Do not lose sight of these wholesales.